Welcome to ETF Wrap, your weekly digest of the top stories in European ETFs. I'm Jamie Gordon, Senior Features Reporter at ETF Stream, and today we'll be discussing whether another fee war is about to be waged in ETFs. Elsewhere, DWS is set to challenge BlackRock in the nascent fixed maturity bond space. And finally, post-Brexit barriers to the UK market. How significant is the FCA's upcoming regulation? First, a series of fee cuts by State Street Global Advisors means they now offer two ETFs with the joint lowest fees in Europe. The issuer's S&P 500 ETF and its ESG equivalent saw their fees cut by at least 2/3, each falling to 3 basis points. Some might assume State Street is losing money on the ETFs, as the fee to license the underlying index stands at $600,000 plus 3 basis points of fund AUM per year. However, the cuts come 3 decades after State Street launched its SPY strategy, now the world's largest ETF, meaning it may have brokered its own licensing deal with the index provider. The ETFs included in the fee cuts were also among 67 State Street recently added to its securities lending program, which will provide the issuer and investors with additional income. It is worth noting that despite boasting the lowest fees, trading spreads and withholding tax on dividends mean State Street's ETF will not have the lowest total cost of ownership. However, the physical replication offered by their ETF makes it less complex than the synthetic rival from Invesco, meaning it could be a prime candidate for retail uptake. Next, German issuer DWS plans to rival BlackRock in the fixed maturity space, with a debut product range expected before the end of the year. CEO Stefan Hoops said in a recent earnings call its Euro corporate bond target maturity ETFs will launch in Q4 following demand from investors. However, Hoops didn't disclose which maturities the incoming ETFs would target. The news comes after BlackRock debuted 4 fixed maturity I-bonds ETFs in August, only to add 5 more ETFs to the range a month later. BlackRock's products target corporate bonds and US Treasuries, with maturities ranging from 2025 to 2028. Finally, incoming regulation from the FCA will remove a key barrier for new entrants to the ETF market in the UK. The overseas fund regime is set to come in from April next year, enabling fund platforms to be recognised and market and distribute their products to UK investors of all levels. The OFR replaces the temporary permissions regime, which enabled existing platforms to passport to the UK following the end of the Brexit transition period. The new regulation will supersede Section 272 of the Financial Services and Markets Act, enabling newcomers to avoid delays and high costs. And that's a wrap for this week. Thank you, and join us again next Friday. Until then, take care.